It's another exciting session, and it's a panel session. And the title is Leveraging Catalytic Capital to Crowd in Private Capital into Social Investments. The panel session is on how catalytic capital can be leveraged to crowd in private capital into social impact by de-risking social investments. And we have moderating the panel session, Oni Peyton Powers. Please, round of applause, ladies and gentlemen. So while she's coming up, she says she likes to describe herself using 4 A's: academic, author, advisor, and angel investor. Please take your seats on a round of applause, ladies and gentlemen. So next, I like to start with the woman first, but let's go with the man now this time around. He's Elias Masilela. He's the chairman, SANDAM, and chairman of the National Task Force. Well, it's National Advisory Board on Impact Investing. They need to cancel that on the program. So, ladies and gentlemen, a round of applause for Elias. He's the managing director of a family investment business, Boomer Investment Holding, and chairman of DNA Economics, Salem Capital Harvest, as well as the national. He's also the chair of the National Advisory Board for Impact Investing in South Africa. Ladies and gentlemen, a round of applause again to Elias Masilela. And last but not the least, I'd like to call on Amalate. She is the Chief Executive Officer of the Impact Investing Ghana. Round of applause, ladies and gentlemen, to Ama. And now I'd like to hand over to Oni to take over the conversation.
There we go. Hi, everyone. Thank you all for coming back. You win extra points. You get grades of A, 95, whatever you're looking for today, for coming back from drinks. So we are going to have a conversation around catalytic capital here. I'm really pleased to have Elias here and Amma to discuss what is a very important part of the ecosystem in impact investing and venture philanthropy in Africa. So I thought at first it might be helpful if I defined catalytic capital. So some of you may or may not have actually heard the term. It's an interesting one because it's a relatively new term for a relatively old concept. The idea, and I've copied actually because the MacArthur Foundation would skin me alive if I got the definition wrong, so I have copied it down here. But really the idea of catalytic capital is capital that steps in where it's needed. And that's what I think about catalytic capital. The actual definition as defined by the MacArthur Foundation is patient, risk-tolerant, concessionary, and flexible. Now, personally, I don't like the term concessionary because concessionary to what? Many of the times what we're doing is building new markets. We are creating what is the market. And so who's to say it's below market rate? If we don't know what the market is, then what is market rate? And market rate for who? For whom, over what time period, and at what value. So I like to think of catalytic capital really as the right type of capital for the right time and for the right organization creating social impact. Now, that may mean it looks different from traditional capital. It may not be equity. It may not be debt. It may not be grants. And if you would like a primer on things that are not equity or grants, I would suggest my book, Adventure, I don't even know the name of my own book, Adventure Finance. So, I'm going to start with you. What does catalytic capital mean to you, and why do you think it's important in the African ecosystem?
Thanks, Oni. It's such a great pleasure to be here and to see so many beautiful African attires. You are all looking very gorgeous. I just had to say that. Catalytic capital means that we get to unlock local financing. In Frank's address, he talked about the need to have local financing be a key part of financing impact across Africa. And that's important because it comes with local knowledge, local networks. We have $30 billion of pension funding in Nigeria, for example. In Ghana, Nigeria's little brother, we have $5 billion of financing. And that financing needs to be unlocked. There are very practical reasons why pension funds in these two countries aren't trooping en masse into vehicles that could deliver impact. And in our engagement with pension funds in Ghana, there were things around being able to assess the level of risk, about having, as a regulated industry, industry-grade vehicles that they could comfortably invest in, because these are people's pensions. They don't want to make a loss. Catalytic capital could come in to offer, for example, de-risking, to make it more comfortable for these pensions to participate. It could come in to design. It could come in to create new institutions that could help with risk rating. It could come in to do all these different things that could actually unlock the funding.
Perfect. And speaking of pension fund and large assets, of large amounts of capital, Elias? Please talk to us about what you think as the chairman of a large institutional capital holder. What does catalytic capital mean to you, and why is it important?
I will not represent any of the people that I associate with because they don't think like me. I see catalytic capital as capital that cares. Capital that looks for problems to find solutions. Capital that adapts to market cycles, that also adapts to social and economic changes. But having said that, those of us who did a bit of chemistry and physics will realize that that sounds like an oxymoron. If you're a catalyst, you're not supposed to change, you're not supposed to adapt, you remain the same. But in this case, it is adapting because it wants to also survive. The truth of capital is that it will only have multiple lives or multiple generations if the stability where it operates. In our environments with growing social instability, growing volatility in the political environment, the likelihood is if we don't invest properly as capital, the assets that we think we're looking after will go up in flames tomorrow. So that's why we have to adapt. In the South African context, I can imagine that those of you who've been here for a day or two, you must have heard of the N3, the famous N3, where they ban trucks like Simba chips. Now, if capital doesn't respond to that mood in society, the likelihood is that the trucking industry will be non-existent in the next few years. And the question is, where do we go? Talking about pension funds, it's very interesting that a number of our pension funds, both in South Africa and elsewhere in the continent, is that they do not have the vision nor the capacity to think like catalytic investors. Why that is the case, in the South African context, the way in which pension funds are structured, or the boards, the way in which they're structured, 50% are representing employer, the other 50% are representing employees. Half the time, those that are representing employees cannot even read a balance sheet. The decisions get made by those representing the employer. And because of the affinity to the employer, the likelihood is that they are going to be short-termist in their thinking, and they are going to make decisions that favor the employer rather than favoring the economy. The best allocator of capital is the one that thinks of the economy first before thinking of the bottom line. A reverse of that is unsustainable. We are talking about the financial sector strife of way back in as far as 1998 still facing us in the face today, it's because we have not lent as money allocators. And I don't know how long it's going to take for us to lend properly. The hat that I would like to wear sitting here is that of impact investors. The kinds of people who think of not the invisible hand. For those who went to school and did some bit of economics, we talk of the invisible heart, where the sequence with which you make decisions is such that you start with what change you want to bring about before you decide what returns you're going to get. But that does not mean you're compromising returns in the long term. You're just guaranteeing being in business for a very long time, for many generations. Thank you, Chair.
I mean, I feel like having Elias and Frank in one room is just, I mean, it's almost too much to have, eh? I mean, it's a lot. It's a lot. All right, so let's talk about some examples. I think we can generalize a lot about what needs to be done in the industry, but how have you seen catalytic capital really have an impact and create both social change and environmental and economic change?
Thanks. We did a study in Ghana looking at catalytic capital initiatives that were launched between 2004 and 2021. Catalytic capital that was expected to unlock financing for SMEs. We found about 172 of such, we call them schemes. They were investing, they were moving or spending money about $1.73 billion over that period. And of that, about 1.1 billion was actual investments going to SMEs. It was supposed to be catalytic, meaning it's supposed to unlock third-party investments. But only of those 100 and something schemes we looked at, only about 10 actually tracked the third-party investments that they unlocked. So that was interesting to see that all this work was done by different organizations, but there wasn't a strong commitment to actually track the impact over time, because the unlocking of capital many times would happen over time. There were many interesting things when we did that research. The first thing was flexibility, and it goes a little bit to Elias's point. You couldn't start off with an investment thesis and say, we will do this and this and this in this sector, and capital will be unlocked, because these were new and innovative sectors, new and innovative vehicles. So you needed to, the ones that did well in their creation, took into account the fact that there were a lot of unknowns and built that flexibility to learn and change and adapt to be able to unlock capital. The other thing they did was that they were very intentional in engaging the capital that they wanted to unlock right from the very beginning. They were very intentional in engaging the key stakeholders right from the very beginning. And so they were able to take the learning into the design of the vehicle or the program and to work with those third-party stakeholders. A few practical examples. One of them was a state fund of funds. Its goal was to create the venture capital industry, which in 2004 was non-existent. Around the same time is when our private pensions also started. And it did a number of things in the early days, investing in different kinds of fund managers, doing fund manager training, some of which didn't work. But it was pretty transparent about what didn't work. And then it tried again with new models. At the time that we were doing the study, it had settled on a model that worked, of working with fund managers that had significant skin in the game, being able to come in with a first loss tranche and de-risk them, and then work with other ecosystem builders to build a pipeline. And so it was interesting to see that the goal had not changed over the time period, but the success had increased significantly because of the commitment to learn and to grow, in spite of a lot of things, including politics and other things that happen when you are a state institution. We also saw another example that was it was run by an international development agency. Typically, they struggle to be able to invest, and so this was a performance-based. Catalytic capital can come in different ways. So this had a mixture of performance-based incentive to incentivize moving capital from into a particular specific serial. That was there was not enough capital there. And it worked. They were able to de-risk and get commercial banks to begin to fund in a sector they were not financing. Though those kinds of program designs, if you're not increasing the pool of funding, you're basically, it's like playing musical chairs. Yep. You're moving money from here to somewhere else, which is great. But we have an SME financing gap of $331 billion plus. So the catalytic capital that we really need is capital that moves from being regular capital into being truly catalytic in ways that expands the pie significantly for the real economy, which are vastly small and medium enterprises.
Yeah, I agree. Excellent.
I don't think I can add much to what she has said, but I would like to request some leniency from the chair.
I don't know.
I don't want to name names, because if I name names, I may find myself conflicted as I go along, and I'm trying to avoid that. I would rather limit it to principle. When all of us leave this room, we carry those principles and replicate them wherever we are. The other thing with examples is that they are circumstantial. So you can do exactly the same thing in one country, it succeeds, in another it doesn't work. Right? So I'm going to start off with an example that has trailblazed in South Africa, and not only was observed in South Africa, but has influenced other pension funds and sovereign funds elsewhere in the world. And that is the Government Employee Pension Fund. They started many years ago with a framework they call Developmental Investment Framework. And all this framework does is to say it is a very bad value proposition to say to a worker, a poor worker in the mines, save for your retirement. You live like a king, but live like a pauper today. And that just didn't add up. So what the GBF decided to do was to put in place investments that actually make this poor worker to live like a prince today, in preparation to live like a king tomorrow. And that is investing where they reside. Now, those who don't know South Africa very well, we have a financial sector that is driven by what we call traditionally white investment advisors who've never seen Soweto, who've never been in the rural area. And therefore, when they advise pension funds, they advise such that they never invest in Soweto. They only invest in the centers. And that has been perpetuated over time. Now, for us to have a change amongst pension funds is to making sure that members of those boards have the right intellect to engage with the environment in which they operate, as well as the advice that they get. So if they get bad advice, they should have the guts to throw it out. Currently, we don't have that. So what the GPF did to be able to prepare itself for the difficult times, they invested in skills on the board. They funded institutions to do research for them to be able to come up with what they wanted to come up with. Now, because they were determined, they were able to drive a program that no other pension fund is able to follow on the continent. But what is interesting is that there's a fund elsewhere in the world called Mubadala in the United Arab Emirates. They listened to what the GPF was doing, and they forced that in their environment, and it is paying dividends. And why Mubadala is more successful than the GPF is not because the GPF is not doing as much as they are doing. It's because the policy environment allows them to do what they are doing. I'm glad that you're going to have the minister today. And I hope you're going to ask her the questions about policy environment. Because it doesn't matter what we do in here. If the environment does not allow for growth, you'll pedal for as hard as you want. You'll not get the outcome. So that is very key. So the GPF framework is a very simple one. It says we are investing to improve productivity of the economy, productivity of skills, and providing access to all goods and services to all members of society. When they invest in a shopping mall, the quality of the shopping mall that they have in Sandton is going to be identical to the shopping mall that they have in a rural area. And the experience that we have seen is that you throw in a mall in the middle of nothingness. All of a sudden, a lot of industries mushroom around that mall. So what has this done? It has provided opportunities. It has provided access. And out of that, skills are being generated. And therefore, for me, those of us who are going to be deploying capital, don't deploy it for the aim of only realizing a return. Deploy it for the question that was asked at the last presentation. What impact are you going to have? When COVID hit us, in South Africa in particular, I'm not sure about other countries, what became very clear is that we could have dealt with COVID much better than we did. A lot of people did not have access to running water, yet that was primary to dealing with COVID. They did not have access to a decent toilet. Many people shared toilets which were not even looked after. So what could have been a crisis of a proportion of 10 became a crisis of a proportion of 90. That's what we found ourselves in South Africa. The private sector realized, went to government and said, government, we think we want to invest differently going forward. We are giving you a proposal, and you don't have to put a cent behind the proposal. Give us all the projects that need to be funded and managed. Private sector will raise the money. All that we want from government is a policy environment that will give us guarantee that in the next 40 years we'll still be in business. This was in the middle of 2020. Today, government hasn't responded to that proposal. What does that tell you? So, it is extremely important to appreciate that as we do what we're doing, we also have to roll up our sleeves to making sure that we force the policy outcomes that we want. It is said that policy is too important to be left to government alone. Private sector needs to run. Now, some of the people in government said at that time it was arrogant of private sector to have gone to government with such a proposal. But if you date back to 2015, when the SDGs were adopted in New York, every head of state reached the same conclusion. We have failed in delivering the MDGs. We cannot fail again. And when you look at SDGs 16 and 17, it's about partnership and collaboration. And what that means is that the private sector is instrumental in going forward. And that means the private sector needs to take the lead. It cannot wait for government to take the next step. And that is the kind of thinking that I would like you to take away from this room. And the examples are really valuable, but I think the framework is important because it can be replicated across time and across space consistently. Thank you.
Excellent. Thank you so much. So I think it's a perfect transition to what I wanted to talk about next, which are things that we'd like to see replicated and scaled. And I'll just start with a few examples. So in my work, I work on innovative financial structures. So trying to find ways to build structures that integrate social and environmental impact actually into contracts, into incentives, and into compensation. And there's a few things recently in my work that have really struck me. And Elias, one of them I think is particularly important to what you're saying, which is the area of impact litigation funding. Probably something many of you had never heard of. I had not heard of it until about a year ago. Essentially, litigation funding is a 30-year-old industry that is a multi-billion-dollar industry globally, whereby people invest in lawsuits. What's now happening is we have our first 3 impact litigation funds. That historically, a lot of this funding has been done by nonprofits, has been done by foundations, by going in. And in South Africa, we have an incredible legacy, actually, of the judicial system really stepping in and often saving large swaths of, you could say, legislative overreach. And so what these impact litigation funders are doing is that they're funding climate litigation to the tune of potentially hundreds of millions of dollars that will be taking on some of these large corporates. And there's a fund actually that's particularly focused on Africa called Restitution Capital that's actually working with governments to go after the bad actors, the corporates, the enablers of those corporates, to actually bring that capital, potentially billions of dollars, back to the country to be able to then use. Because, Elias, you're right, if we don't have a policy framework, but a lot of, South Africa's different, we've got a lot of money here, not spent well, but a lot of other countries don't actually have the money in the fiscus. So you get an anti-corruption crusader or someone that comes in and says, we're going to, make good on the SDGs, but they don't have the capital to do that. Some of it because bad actors have taken that capital away. And so I think a great example of catalytic funding is actually going after and saying, it's not all about you sitting and trying to make the best of what's left. Go after some of these organizations that have taken capital actually out of these countries and put it back. Same thing with climate. We're saying it's not priced in. All of the oil companies currently aren't pricing in the actual cost of this. Well, then make them price it into their models. And we need actually to get some of the actual economic costs that they have actually wrought on some of these areas to be able to have that capital back. So that's an example of catalytic capital. It's not just about necessarily grants. Some of these are investable, et cetera. And then one more I would say that I pretty much always say in any big room that I'm in, which is just guarantees are just such a beautiful instrument. They are underused, but they are so effective. Whether they're from a government or from a foundation, a guarantee as a first loss within a fund, underwriting a piece of it, going up and helping to guarantee a social entrepreneur. I mean, there are just guarantees, guarantee pools. If you want to talk to me about guarantees, I love them if you have questions about them. But they are just such an elegant, simple use of capital, often using balance sheets that are completely underutilized to be able to help others have access to capital, potentially at cheaper rates, particularly in some of these markets whereby the actual cost of capital is significant. So guaranteeing in US dollars or in euros, some of these costs can be, for me, I'd love to see more of both of those. So, Elias, I'm going to start with you, and then Amma, I'm going to let you have the last word. Elias, what would you like to see more of, other than, I agree with you completely, policy framework? And if anyone's interested in some really good writing on policy for impact investing, the National Task Force on their website has an excellent report that lays out policy prerogatives, and that's worked with Ghana and others to do that. So just a little plug for Elias's work on policy as well. But Elias, please, what would you like to see more of?
You've raised an issue which is a dichotomy between corruption and productivity. And I think for South Africa, I'm not sure with the rest of the continent, corruption is our most painful Achilles heel. And we need to do something about it. So there are three kinds of funds that I'm going to recommend that we think about going forward. One is the one that we already know. We need more outcomes funding. And this, I hope, is going to educate our governments that it is not inputs that we should be measuring. It is outputs or outcomes. The second one is what I call a whistleblowers fund. Now, to deal with corruption, whistleblowers are extremely important to bring about this corruption. But in South Africa, whistleblowers are crucified. They're actually even burned to death. So we need a fund that is going to protect whistleblowers. These are angels to the economy that make sure that crime doesn't happen unfollowed. And the third one is a fund that was just originated with Betha as Impact Investing South Africa, which is what we call a bail fund. There's a lot of people who rot in prison or in jails for innocent reasons. And we're saying there is a case to get those people out so that they continue to be productive and gainfully employed members of society. Not only that, that kind of fund is going to help the fiscus in generating huge savings that can be invested in other productive areas instead of keeping people behind bars. But that too requires a high level of honesty from the justice system. And we don't know who's going to deliver that. Thank you.
Thank you. Great examples. I would add to that, when I look across Africa, I see a lot of local financing vehicles, really innovative, being set up. So for example, in Nigeria, the National Advisory Board there is designing a wholesale fund. It's a 1 billion fund to, it's unlocking government funding, it's unlocking pension funding, and it's going to be working on a number of innovative sub-funds, mostly funding SMEs. There's a lot that Catalytic Capital could do to bring that vision to life around its initial design, that's almost completed, around its structuring. And it would be good to see more collaborations. And we tend to see large, well-publicized catalytic initiatives regionally, and not so much catalytic initiatives that are focused on a specific country, or that are, if they are a multi-country program, involve local actors across countries collaborating. There's a similar fund, it's a guarantee fund in Zambia. In Ghana, we're working on a fund called Chigaba, which is a pension-backed fund of funds. And would love to see more of those, more initiatives developed in Africa that respond to the local needs that are catalytic and that are partnering. And would like to see Catalytic Capital going into ecosystem building. So AVPA is launching a membership program. Frank highlighted some gaps. Some of those gaps come with investment opportunities. A lot of Catalytic Capital, like a lot of capital, doesn't take a stakeholder perspective in the decisions that is made. The decision-making panels, the investment committees are not diverse and do not include empowered stakeholders who can influence those investment decisions in a way that drives both return and impact. So would love to see more diverse panels, would love to see more collaborations that engage stakeholders and more empowering of stakeholders to truly participate. And then I think we'll begin to see change happening at scale.
Wonderful. I want to underline that point because I think it is such an important one, and I'm sorry that it was at the very end of the panel that we talked about it. But it's not just about what type of capital is invested; it's about how, and how is also who's around the table. So I just think that's a really important thing. Look who's around the table, make sure the type of capital is responsive, make sure it's capital that cares, but really make sure that when you're designing these types of instruments that they are local, contextualized, and really do empower the stakeholders. Thank you, Amma, and thank you, Elias. We're leaving.
Thank you very much, ladies and gentlemen. Oni Peyton Power, Amma Latte, and Elias Masilela. Thank you very much for that very informative panel session on catalytic capital. In fact, I think we need more catalytic capital in our market, so thank you very much for that. All right.